will make you pay more for your own good. Let's have a look. Hello everyone, Florian here, and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's check out an article here from Yahoo Finance. This is one that's going to get people rather angry and frustrated. And, well, as they say in the title, it defies logic. But then again, Australia is a nanny state. You have to remember that. Put all the libertarian, individual, free responsibility and freedom ideas to the back of your head. We're the nanny state here. We're going to want the government to intervene. We want a regulated market. Nice little bumper ball living. Okay? Can't deviate. Let's pretend you've got that freedom there and bumper ball you into servitude. So let's look at this. Borrowers trapped in a mortgage prison hit with $389 extra cost defies logic. Let's look at this here. Mortgage holders can be locked into high interest rate loans and are unable to refinance following a ruling by the banking regulator. So I know everyone loves to bitch and moan about the banks and how every lazy lefty complains about the banks and any business making profit because, of course, they think profit is a four-letter word. If you want to get a share of the bank's profit, invest in them. That's a mind blow right there. We still have the freedom to do that for now, until they take it away, unless you eat so many bugs for lunch. This could leave some borrowers stuck paying hundreds of dollars more each month than they should be. The Australian Prudential Regulatory Authority, APRA, announced it is keeping the 3% buffer. Okay? The 3% buffer. So when you're calculated on how much you can borrow, it's not on what the rate is now. They have to chuck 3% on top of it. So say you're paying, a higher rate and you want to refinance at a lower rate, they need to recalculate that with the 3% on top of it. So you could get a lower interest rate value, a better deal from probably a competitor bank, but they can't do it now because APRA is intervening in the market. Now, I'm going to put my little conspiracy theory hat on. Where I don't have a hat. Okay, here we go. My Tim Pool beanie. There we go. I'll put that on there. Now, do you think this is something that the banks may be pushing for in order to ensure people are trapped with them? So you can't go to a competitor. It's much easier to kind of pressure subtly APRA. I'm sure it doesn't happen. I'm sure not at all. To implement these 3% buffers for the greater good, for the good of all of us plebeians, because we're too stupid to manage our own finances. And then you're stuck with that bank because you can't go anywhere else. And then they won't have to give you a better deal because you can't go anywhere else. So here we have a rule designed to bumper ball our housing market, bumper ball the bloody mortgage broking and mortgage lending business, and protect the banks and ensure there's stability in our housing market. This is why you're not going to see a crash there, Doomers. You're not going to see a huge crash because we got so much shit like this in Australia. Okay, but the problem is, for this type of stability, some people are going to get screwed over. But that's the Australian way. The greatest good for the littlest amount of harm. So what if a few thousand people have to pay extra on their mortgage? The rule makers won't care. The bureaucrats won't have to worry about it. It's nothing they need to care about. The politicians will be... All of our ruling class in these type of organizations will have more than enough funds that this doesn't matter to them. So, the regulator raised the serviceability buffer from 2.5% to 3% in October 2021 to protect borrowers. Are you sure? Isn't it to protect the bank? When the cash rate was at a record low of 0.1%. They really should have raised it to 7% then. CanStar Analysis, shared with Yahoo Finance, found the buffer could be creating a roadblock for existing borrowers trying to refinance to a lower home loan rate and lower their repayments. Existing borrowers were paying a $600,000 loan over 30 years with an average rate of 6.37%, who applied to refinance to a lower rate of 5.89%, would be assessed at a rate of 8.89 once the buffer is applied. So there you go. So you're shopping, you're being good. You're shopping around, you're listening to Koshi in his article, you're shopping around to get a better mortgage deal, but APRA goes no, puts their boot on your throat and says, no, you must be calculated at this rate because that's what we say. And you may not be able to pay a 9% mortgage. Or maybe not according to the bank. Maybe you could. But the bank, their buffers may be out there. Refinancing could potentially save the borrower $186 per month. If the borrower was refinancing from the average rate of 6.88, the savings would be even greater at $389 a month. So we're not talking small amounts of money here. I mean, sadly, you can't get much for $200 at the groceries anymore. I mean, I went shopping, last night? Make tacos. And I probably went through $120 just getting the veg and all the meat. But then again, meat's expensive. It's worth it. Still, that could be enough to keep you in your house. That $389 a month could be enough, if you're cutting it fine, to keep you and your family in your house. I mean, wouldn't this be the first thing you think about when you're doing it tough? I mean, in the past, when we had tougher times financially, that's the first thing I did, was look at how I could consolidate, simplify, make our life easier, cut all those costs. But there you go. APRA may not let you. But if the lender determined they weren't able to service a loan with the buffer added at 8.89%, the borrower would be declined for the 5.89% loan and unable to refinance. That's despite them already repaying their loan at a higher rate. And this is where I question if this is done with intention to, I don't know, probably not. Probably not. That's a bit too dramatic, isn't it? Too exciting. It's just bloody, you know what it is. It's just civil servants' incompetence, or just expecting to throw a few thousand people on the pyre for the greater good. It's not like it's going to make any difference to the banks. They'll still be raking it in. CanStar Group Executive of Financial Services, Steve Mickenbacker, said he understood why APRA maintained the buffer for new lending, but said it didn't make sense for those refinancing. What they're effectively doing is locking people into high interest rate loans, potentially, so they're not helping system stability at all, he told Yahoo Finance. You know what, honestly, I think the banks would prefer it if these didn't exist, so they could compete easier. They want to fight to get your loan. They'll give you a good deal. If you're a good credit-rated client, people are already in that situation, and refinancing to a lower rate is actually improving their situation, not worsening it. It defies logic. Well, you're dealing with civil servants here. They don't need to deal with logic. A borrower earning the average Australian income of $98,000 a year is currently spending 46% of their income on an average 6.37% home loan. Okay. Now, you'll see stuff like this in these articles all the time. You need to double that. It's not a borrower. This is the average Australian. How many mortgages are with one person and how many are with a household? I know we get all these articles on the news.com and wherever bloody else that young kid working at Macca's builds a property portfolio. Most normal people do it as a team. So, it is sure that sounds scary, that 46%. Mortgage payments have risen by more than $1,500 a month on the average $600,000 loan since the RBA began its rate hiking cycle in April 22, leaving many borrowers eager for relief. So borrowers stuck in mortgage prison. We've heard this time and time again. Just like the mortgage cliff, just like the interest-only cliff. Remember that? Remember when there was talk of that? What happened there? I don't think anything happened there. Mortgage brokers have warned there is a growing number of borrowers stuck in a mortgage prison and unable to pass serviceability tests to refinance. It found serviceability was the number one barrier to refinancing. A recent survey from the Mortgage and Finance Association of Australia found 84% of borrowers had clients unable to refinance, a slight rise from 82% last year. Oh boy, that's That's bad. We've heard repeatedly from our members about clients who are good borrowers with a strong repayment track record being unable to refinance simply due to buffer rates. This is even when the client's repayment would actually decrease if they were to switch lenders, trapping many Australians into a mortgage prison. So here you have a market intervention. This is artificial. This is regulations brought in. I think if you can't hear it, the possums who lives up here has snuck outside. So if I get attacked, you'll realize this market intervention by this body is changing the rules, forcing all these banks to assess them at a certain way because we want stability. Australians want stability. I mean, we all know that everyone will be bitching and moaning to a current affair. You all know it just has to be a significant number of people will be bitching and moaning to the government for shared equity. It'll happen. Last year, Commonwealth Bank announced it would lower its serviceability buffer from 3% to 1% for eligible refinances. Westpac and NAB also announced they would relax their tests for certain refinances. The MFAA found these moves had made it somewhat easier for borrowers to refinance, but strict eligibility requirements made it difficult for some to assess. Okay, well, I'm hoping, what's he broken there? I'll keep going. I'll check the damage later. Yeah, bloody Queensland, eh? I need that big python, but we had a big 3-meter python here. I need him back. He'll take care of the possums, and that's all nature. That's allowed. So, at least I hope it is. ANZ CEO Shane Elliott has also proposed cutting the 3% buffer and said regulators were locking out Middle Australia from being able to access home loans. When announcing its decision to hold the buffer at 3%, APRA Chairman John Lonsdale said he was concerned the level of overall risk to the financial system remained elevated, with high levels of household debt and inflation still above the RBA's target range. Given the uncertain economic and interest rate outlook, including the possibility of higher cost of living pressures, it's important that prudent buffers are incorporated in serviceability agreements, he said. APRA will continue to monitor closely bank lending standards and the broader operating environment, and should we believe a change in macroprudential settings is necessary, we will make the appropriate adjustments when needed. Let's have a chat about this. So, bear with me, but I don't remember voting for the APRA body and members. Did we get to elect them to regulate our banking sector to this degree? I know why they're doing it. We don't want the craziness of other parts of the world. But this is the consequences. Some people are going to be thrown to the pyre for the greater good of the stability of the Australian housing and mortgage sector. So just bear all of this in mind the next time you hear one of your mates telling you that property's about to collapse. Okay, I know it's all fun, playing the prepper. But guys, I can't see it. What do you think? Do you think these buffers are a good thing? Have they saved many people from falling over the cliff? Did they work? When rates went insanely low, the buffers mean we've got not a huge cliff of people, forced to sell their houses. Sure, you've got some, but it's not the apocalypse that many people anticipated. Are you a fan of them or not? Let me know in the comments below. As always, take care. I'll see you next time. And I'm going to go check to see what the possum broke. See you later.